Ray Dalio, everybody. He is the founder of Bridgewater Associates. He's a deep thinker. He's the author of the best-selling book, Principles. Ray, welcome. Great to see you. Thank you for joining us.
Great to be here. Thank you for having
We're going
me.
to kick things off with one of those polls that I mentioned. Ray, this is a question for our audience, not for you. And here it is, everybody. When do you expect normal, and I'm saying normal in quotation marks, normal business conditions to return in your industry? As you can see here, we've got four responses: third quarter of 2020, fourth quarter of 2020, sometime in 2021, and the latter is later than anybody thinks. So please register those responses, and we'll see when we've heard from enough of you what it all looks like. Ray, I think that's a convenient segue into our conversation, and I'd like to begin by asking you this question, or at least asking this of you. Tell us, if you would, about the work you and your colleagues at Bridgewater have been doing trying to understand this pandemic, and share with us some of the conclusions you've reached about its impact on the economy.
Well, I think you know that I believe basically almost everything has happened before. You know, one of the great things about getting old and reading history is you see these things happen over and over again. So this is an economic downturn. It's caused by the pandemic, and you know, we can even go study pandemics and what they're looking like, which we've now done. We wish we had done that before, but. So there's this economic downturn, and the way it works is basically that everybody has a certain amount of income. Every individual, every company, every country has a certain amount of income, a certain amount of expenses, and a certain amount of savings, balance sheet. And so this has been a hit financially to income. And it's been a hit to balance sheets, assets. And then so think of those as holes. There's been a hole in income and a hole in balance sheets. And then there's the capacity of central banks and governments to fill in those holes. So there's a financial world. And then that financial world, governments produce money and credit out of thin air, basically, and they can fill in those holes. And so this is a moment which is very analogous to announcements that have happened in the past. March, President Roosevelt announced that there would be the printing of money and credit, and there would be a severing of the relationship with gold at the time, so that they could print money and credit and create credit and to fill in those holes. And that was the exact bottom of the economy. In 1933, March of 1933, the exact bottom of the markets, the exact bottom of the economy. Similar things have happened throughout history. We can remember that when 2008 financial crisis, the bottom occurred when the federal government, Congress, and the president created a program to save the banks and to fill in that hole with money and credit, but it's also produced by the Federal Reserve to go buy financial transactions and make those purchases. And that created that bottom because they're filling in the holes. And you could take that when Mario Draghi said he'll do whatever he takes. And then the European Central Bank produced money and credit and filled in the holes. And so the issue is really at those moments, there are the filling in the holes. And so there are two dimensions to that. You can't raise production. You can't raise real wealth by producing money and credit. You could just fill in the debt holes and that process. So we're now in a process of those holes being filled in, and it's very important to look at what holes exist and what they'll be filled in with. And what I mean by that is Americans have holes in different ways. Different Americans will have it. And what will be produced? We're very lucky because we have the world's central bank. So think about it this way: 70% of the world's transactions and savings and most everything is in dollars. And so they buy, they sell, and they save mostly in dollars. And because the Federal Reserve produces that money and credit, it will target it at Americans, and they'll work out exactly what holes will fill in and so on. But we're, in a sense, the world's money, the world's credit is that which is produced by our central bank. But that money and credit really won't go much farther beyond those Americans. And we'll need to talk about what that means for Americans. But it won't go much farther. And then there's a European central bank, which is not nearly as powerful. So there's all of that going
And
on. I'm probably going on too long, but it's filling in the
I was
holes,
just
and
going to
there will
say,
be a big, there'll be as
could
to who.
before we get
So
into some of deeper into those holes and deeper into the programs that the Federal Reserve and the government have undertaken to try to fill them in, can you give us a sense, Ray, of two things? First of all, how big is the hole? And how big a hole are we talking about? How long is that hole going to last? Just to give you an idea of what the audience thinks, our viewers don't think they're going to be back, that their businesses are going to be back to normal conditions until sometime in 2021, which is probably about a year from now. So give us a sense of how long you think it's going to take and how big a hole we're going to have to fill.
well, the holes to incomes in the United States, we estimate somewhere in the vicinity of $5 trillion, and the holes in the world economy is probably somewhere in the vicinity of $20 trillion. And we look at particularly who has what holes, and then how they'll be filled. The economy as a result of this, so the real economy, which is goods, services, production, and all of that, um, in the world over the next year will probably have a fall of maybe 4 or 5%, which is a bigger fall. This is a bigger event than the 2008 financial crisis, and it's most comparable to the 1930 to 45 period of time in terms of the size of the hole, the unemployment rates, and those types of impact. And then we'll adapt. One of the great things about the greatest force is in humanity and the greatest force in productivity is the capacity of humans to adapt and change the way they're doing things. And we're doing that right now. And so I'm pretty confident that the inventiveness, the adaptation will bring us to a new way of operating. And let's say if you take that decline, that'll be a peak to trough decline of somewhere in that magnitude. That will get past that, but it'll be a total new world order. The world won't resemble the world that we're used to. It's going to change in various ways. So it's a big hole. It's not a unsustainable hole because the capacity of producing money and credit is unlimited. It means that we have to look at what is the value of money and credit. Okay, that new world. What is the value of money and credit? What is a storehold of wealth? Okay, you just can't produce it without it having its effect on its value. And so while we talk about production, we'll adapt and we'll get past it. But how wealth will change will be very, very big and different.
I'm going to come back to that in just a moment. And I keep saying I'm going to come back to the things you're mentioning, but I promise I will, Ray. In your opinion, is what we've seen thus far in the way of fiscal stimulus from the federal government and monetary stimulus from the Federal Reserve appropriate? Are both of those organs of the US government, if you will, doing what they should be doing? And if they're not doing quite enough yet, what else should they be doing?
Yes, in my reaction, there's no choice. It's like in the 2008 financial crisis, you're faced with a choice. Do you want those banks to exist in the future, or do you want to get rid of those banks? And they may have gone broke, and they may not have had enough savings, and they may have done even things that they should bear the consequences of. But you want to save the banks. And so this is a crisis that's similar, except it goes way beyond the banks. So when you start to think, who do you want to save? You have to think about, do you provide them with income, and how much do you deal with their balance sheet? And if you don't do that, the consequences are enormous. So the reaction needed to be of the sort. We have to think about the consequences, though, of producing all that money and credit. Where does it come from and what does it mean? We'll turn to that in a minute.
So
But it's just like in the
no,
Great Depression, you needed to do that, and you will need to do more. And we will argue over what we should do and who gets what, and that'll be our big discussion. But yes, there has to be more money and credit, and you have to operate in a way where you save important things, and that you only impose a certain amount of suffering on people that they can bear. Otherwise, you'll have a revolution, and you won't have productivity.
Ray, can we talk about some of those consequences? I think that's a critical part of this conversation. When you say the word consequences, are you thinking about economic consequences like inflation, for example, a product perhaps of all the liquidity that's being generated by the government? Are you thinking about the impact that it has on the treasury bond market? Are you thinking about the impact that it has maybe on the foreign exchange market? Are you thinking about those things? Or are you thinking more broadly? Tell me.
Of course, it's my responsibility to think about all of those things. And that's my passion since I was a kid. I'm thinking about all those things. And then you also have to bring in the elements of wealth gaps and politics. The world does not operate just without consideration to how wealth is distributed. So I'm thinking, for example, that when we look ahead, the world is going to be very different. Like when we think about how you'll pay for it. Okay. Will there be a reversal of the corporate tax cut, for example? The paradigm that we were in since about 2008 until it ended with the downturn was one in which just mechanistically certain things happened that supported markets. And they included things that probably are not repeatable. For example, when you had a corporate tax cut, the decline in corporate tax rates benefited stocks. When you had interest rates go down, the effect of lowering that interest rate caused all asset prices to rise because they all compete. And so that causes a price earnings expansion. But we won't have in the future interest rates go down in the same way. You had expansion in profits and wealth assets prices going up for the purchase of those, and that benefited those with assets more than those without assets, and that created a wider wealth gap. So you had low levels of interest rates cause corporations to borrow and to buy back stocks and to buy other corporations because the returns on equities were greater than the cost of funding. And that supported prices. And that created a certain cash flow. You're not going to have that. So as we come into the new paradigm, we have to realize that even, how is capitalism? How will it mechanically work? What does it mean for redistributions of wealth? All of those questions are part of the same series of questions you asked. So when I think about foreign exchange, when I think about each of the markets, I have to look at it in that holistic way to figure that out. And then I think about that globally. You just can't think about it as one thing. The United States' conditions are different from Europe's, and a difference from China, and different from other countries. And those differences are important. So I have to think about all that. Yes.
Now, I was just going to say, could you give us a sense? So you've established some really valuable context, but I want to try and get a better sense of how you think it's going to play out. So things are not going to be the same. What is going to happen with inflation? in the period after the financial crisis, we saw this monetary levitation. We saw asset prices rise. As you pointed out, we saw um, a widening of the wealth gap, if you will, the rich getting richer. We did see the buybacks that you talked about, the amount of leverage that was built into the corporate economy. How will that be different? Are we going to have more inflation? Will asset prices rise the way they did before? Is, to the point that you just made a moment ago, will the Fed in its asset purchase program be able to manage interest rates and yields, more importantly, market yields, the way that it's been able to up until recently?
Well, you gave me a bunch of questions there, so I'll take them bit by bit. Let's start with the inflation component. There's inflation in goods and services, and then there's the value of money and inflation in certain assets. I think the period that we're going through right now is most analogous to the 1930 to 1945 period in many, many, many ways. And so in that period, what you had is deflationary pressures, much the same way as we have deflationary. I mean, think about is the supply demand of goods and services such that it's tight? And well, in other words, we're short of the goods and services, and so prices are high. And that's one type of supply demand inflation. Then there's monetary inflation. And so, like in the 1930s period, when you had deflation of goods and services, and you had inflation because of financial assets and other things because they produced it. And so you saw a series of currency declines. So you saw one country after another devalue its currency in relationship to other countries' currencies and in relationship to gold, which was then considered the money. And so there were those devaluations. Very similar. Another period of time that seems very similar to me is the 1980 to 1990 period, because what happened then is the world had a lot of debt and money was tight. And then what happened is there was a debt crisis, and it differentiated some countries from other countries. So the emerging countries that owed a lot of debt and also didn't have the best benefit of the money that was coming out of the Federal Reserve had a crisis from 1980 to 1991 when they put the Brady bonds in. But at the same time, the United States was going through a reflation period in which assets reflated, but inflation rates fell globally. So it's important to distinguish what we mean by inflation. This is not a supply demand kind of global supply demand. We're going to be short of things, we're going to bid up its price kind of inflation. We have to deal with the monetary inflation. And I think in the early stages of this, you're going to see it reflected in asset prices. So you see it reflected to some extent in gold and to some extent into stocks and other things. I can get into what I think will be the sort of the beneficiaries of that. It'll be a different kind of world. It'll be difficult to, it'll be a very selective world as to what will do well. But pay attention to the value of money. What is a storehold of wealth? No, don't just look at goods and services, because I think when we look at an economy the way we normally do, we just think it's all a function of goods, services, stocks and bonds and so on. And we may not pay enough attention to the value of money. I think we'll be in an environment where that'll be a very important issue.
Ray, I'm just going to take this opportunity to ask the second polling question of our audience. Let's bring it up, and here it is. What quarter will the U.S. economy return to positive growth? Will it be the third quarter of 2020, the fourth quarter of 2020, sometime in 2021, or once again later than anybody thinks? I'm going to give the audience time to think about that for a moment and to register their responses. Ray, I'm going to take this opportunity as well to weave in a question from our live audience. I can't tell you where it's coming from, but it seems relevant given what you were just saying. Is it surprising for you, Ray, to see global equity markets enter what amounts to a new bull market while we're still in the middle of one of the worst health, economic, and financial crises in modern history?
No, not at all. I mean, just like you can go back to the dates of announced reflations. You have a hole. The economy follows. What this is the important thing. Even when you're asking the question of others, when will it fill in? You have to understand the financial part of it, what it means from incomes and balance sheets. And so what I'm saying is, let me give, I can give you the dates. So it was the date that the bottom, when the Federal Reserve and the Treasury in 2008 announced its program to produce enough money and credit to buy financial assets that we entered the new paradigm. It was the date that
I'm
Mario
going to interrupt you
Draghi.
for just a moment. Uh, I'm interrupting you, Ray, just to make one point that I think people are trying to wrestle with right now as they listen to your answers. You're absolutely right that the Fed and the government, for that matter, at least in this country and then elsewhere in Europe, uh, took action in 2008, and clearly the federal government took action and the Fed took action back during the Great Depression. But there's often a lag between the moment they fire the bazooka and the moment that we, so to speak, hit bottom. The bazooka has been fired a number of times over the past few weeks. We don't know whether we've seen the bottom, whether it's the economic bottom, probably not yet, or the financial market bottom. How do you think about that?
I I think you're not adequately distinguishing economic activity and stock prices and financial market considerations. I learned this early in life. It was so funny when I was a kid. I was, invested as a kid, and I would see the economy get stronger and stronger and stronger, and I would see the markets go down, 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 and then I would see the economy get weaker and weaker and weaker, and then I would see them go up, 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 based on what the amount of money and credit is. So like it goes when it gets stronger and stronger, and let's say money becomes tighter and tighter, and central banks become tighter and tighter. That has an effect on the present value of all cash flows and so on, and that's more important. And so the real economy lags the financial economy. So if we're looking at that, we first have to start off with the financial economy, and then we have to say, where does the money and credit flow? And you have to follow those flows. I mean, down at a detail level. So then that's what we try to do. Okay, so money and credit is going to buy they'll buy, what do they buy? Okay, they will buy first investment grade. Starts with Treasury. Then they buy investment grade. Then they buy junk bonds. Okay, what is their objective? Who is going to get the money and credit? What will that mean for the cost of funds? And then you have to follow that money and credit through. I think, just to answer your question, I'm saying it's a money and credit question. At the same time, I can't tell you how much this. I can give you my thoughts about what will happen in terms of it passing through. If I get down to the granular, I think that what will happen is it'll be a big shift in wealth. It'll be a big shift in where things go. And, so when I look at that, I think it's a mistake to look at the economy as a whole. Like, everybody's saying the economy as a whole. There's this economy, and it goes up and down based on what they do. But it's not going to be like that. It's going to be more like this, that they're going to change the nature of that mix in a very important way. And that mix is going to change. So while we see, let's say, a 3 or 4 or 5% decline, and then we think about what are our impediments to bring economic activity up, we'll get past those impediments and we'll bring economic activity up, okay? But the balance sheet damage, the income damage, and who is going to get what in that new economy are the most important things. So the flow of
Ray, just a
money,
minute.
let me give you an example. The
Sure.
1971 move by President Nixon, okay, to devalue the dollar and print money. did not help the stock market much. Stock market did not perform well.
No.
Gold, a lot went into gold. A lot went into inflation hedge assets. It created an era that move in August 15th, 1971 created the 70s. Okay. And because of the way that money flowed. So when you ask of stocks, I can't tell you how much stocks, I can't tell you what other assets. As we're working that through, I have my theories and I can tell you. But the nature of that is it's a reflation in which the value of money will go down and the value of other things that are of a certain nature, certain types of stocks, certain types of other financial assets in certain places in the world, which we can delve into if you want, will be the big beneficiaries. And the world order will change in an important way based on who those beneficiaries are, just like what happened after post 1971, just like what happened after post 1933 when
So let's do
those
that.
changes.
Let's do that. Share with
Okay.
us your theories. Who are the beneficiaries going to be, and how is that going to be reflected in the things that we see, like prices of assets and prices of goods?
I believe that as we distinguish, we can do that by countries and parts of the world, and we could do that by asset types and so on. I believe that when you look at bonds um, and debt, a bond is a promise to receive currency. So you have, when you're holding a bond, that gives you no interest rate or a negative interest rate, and they're producing a lot of currency, and you're going to receive that. Why would you hold that bond? Okay, and where is that bond, and who owns that bond? Okay, so this period, like the 1930 to 45 period, is a period in which I think you'd be pretty crazy to own bonds. Okay, because what is a debt? A debt in a fiat currency is a promise to receive currency, and isn't it pretty clear they're going to make a lot of currency? So I think that changes the appeal of bonds. Why in the world would you hold the bonds? And that has a big effect. So when you start to think about how much wealth is in bonds, and where is that wealth going to go? And how's that going to work? And how are they going to control it? You know, I have real thoughts about that. So what is a good storehold of wealth when we're all holding all of these debt assets? And how will that play out? That'll be an important consideration. Another, and that has to do with storehold of wealth. And so when I think of storehold of wealth, I think, what are the stable storehold of wealth in the form of stocks and other kinds of debt? I want those that have strong balance sheets, stable incomes, and so on, so that you're basically having those assets that will perform well in any kind of an environment. And I'll look at them based on how cheap or expensive they are. And when I think of the world, I divide the world into different locations. As I say, I think that this picture is very much like the 1980 to 90 period, when we're flooding it with financial assets, with money and credit, but they're not getting to a number of emerging countries. So when I look at the distribution of wealth in terms of their balance sheets, like every individual, I look at what is their income, what is their expenses, and what is their savings. And when we go through that exercise, then it changes. I don't want to be in places that don't have good ones. And then I look at civil behavior. How are people with each other? Is there going to be a fight? And will people be orderly? Will we work it out? And then what will be the changes in tax rules? Taxation. Will corporate taxes come back in certain ways? What will the changes? Because we're not going to deal with that equally. So I'm looking at all of that to create a picture of differentiation. I see a very differentiated world. And when we talk about the economy coming back, I think you have to realize what big changes are that are behind that can't be changed. Let's say, for example, self-sufficiency. I think we're going to produce different things and we'll be self-sufficient. We operated in a world where we were globally connected and whoever was most efficient would get it, and we would just go get it wherever it was most efficiently produced. That world won't happen again. So you're going to come to a world where you'll originate it, produce it at home, and that you'll start to think about what do you need. And I imagine that we're going to be rebuilding our basics, healthcare systems. How much savings are we going to put into rebuilding some of those basics, like basics of hospital? What's our storage for the next time we have the next epidemic? And then there'll be other things, climate change. This is the act of nature that hit us over the head, the virus. But there's other evolutionary costs that are going to come in the form of climate change and those types of things. All of those things are important to imagine in imagining the new world order, I think.
So, you and I have talked in the past, Ray, about your concerns over populism, your concerns about inequality, your concerns about capitalism, and some of the flaws that you had observed or believed existed in the system that we still have. And now you've raised the question as to whether there's going to be a fight over wealth. Is there going to be a fight over wealth? Let's just talk about it in terms of this country. What is going to happen in that sense? Is there going to be a battle over tax rates and redistribution? Give me a sense of what you have been thinking and what you anticipate.
Well, again, I'm just a mechanic who tries to be a practical guy. And so when I answer these questions, I don't answer them ideologically. I'm just trying to answer them mechanistically. So as far as what I believe and what I've written, I wrote a piece which how and why capitalism needs to be reformed. And I'm a capitalist. So sometimes you get thrown in as just a generalization. And before this, it struck me that if we have a downturn and we don't have much of an effective monetary policy, we're a particularly risky position, and it's fundamentally not good that we don't have that we have such a problem in terms of the outcomes. It mechanistically, for history, when you have people who share a budget or share wealth, and you have a large wealth gap. And so when you have a large wealth gap and there's an economic downturn, there's a high risk over fighting over wealth. I mean, that's just history. We see it happen over and over again. So most probably there's a question of whether we'll do that well or whether we won't do that well. And I can give historical examples of doing it well and not doing it well, but mostly it's a risky thing that people don't do well. And then in addition, it struck me that the system is not producing the desired outcomes in totality. Because what is the desired outcome? When I was growing up, we created a new world order in 1945. 1945, end of World War. 1945, we created a new dollar-based monetary system. 1945, we began a new world order, and we had the United Nations in New York, and we had the World Bank and the IMF in Washington because it was the American enterprise. And then we had 80% of the world's gold, and we began a process. Now we're heavily in debt, and we are at those kinds of limits. And so how are we going to restructure that world order? So when I look at it, I think in terms of your answer, it depends very much on how we are together. And will we bring the country together? Like the togetherness and being behind a common mission. And what is that common mission? I believe, what is the American dream? Do we know what the American dream is? Or do we each have our individual dreams, like I want to get richer and I want to do something else? And so to me, when I was growing up, the American dream meant something like equal opportunity. I was very lucky to be raised by two parents. My dad was a jazz musician, a modest income, but I was able to go to two parents who loved me, and then I was able to go to a public school, and I got a good public education, and then I was able to go into a world of equal opportunity. And it's those kinds of fundamental things. So we'll need an American dream. We'll need to do it together. And we need to do it harmoniously with those who are competitors in the world like China, if we're going to do this well. And so I think we're at a juncture of deciding, we're in a fork in the road that you will find out in fairly quickly in the next year or two about whether we're going to do this in a harmonious, bipartisan way that we can get through our disagreement or not. And everything depends on that. There's enough wealth in the world and enough opportunity and still the inventiveness. So what we have to do, it's an engineering exercise. What we have to do is engineer intelligently how to increase the size of the pie. So productivity increases and you increase the size of the pie, and then also divide it well. So we have not only divide the wealth well, but divide the productivity opportunities well. So like investing in education is a great thing. But in any case, yes, how we are going to be with each other when we're creating this new world order is going to be the most important thing.
Ray, I'd like to turn our attention to some of the questions from the audience. Many of them are very similar, which gives you a very clear sense that there are a number of specific things on the minds of people who are out there, and more importantly, the people who are listening to you right now. And I'm going to try and summarize these questions because a number of them dance around the same issue. Some critics say that this is specifically about the Fed programs, Ray. Some critics say it's wrong for the Fed to be in the market buying corporate bonds, buying investment grade bonds and buying junk bonds, as opposed to what they used to do, which was treasuries and agencies, because it's picking winners and losers in the real economy. What do you think?
I think everything is a matter of weighing the pros and the cons. And what happens over a long period of time is that whoever steps into the job inherits that which happened before them. And then they deal with that thing in the best possible way. And over a long period of time, that's bad. Because let's say a government official, you become a governor of a state, and what happens is there's an incentive to spend money and borrow money, because at that time, if you borrow money and spend money, people look at how much you're spending, and you can produce a prosperity on borrowed money, and then you leave your term, and then the person next inherits what they have. And so when you're head of the Federal Reserve and you step into the existing job, you have an overly indebted economy that and you have a situation where if you just bought government bonds in the traditional way, which it is in of itself a problem in a sense, and you just bought that, then you have to allow the other parts of the economy to go broke. And then when thinking about that, you have to then say, what do you do with that? And you have to do it quick, and you have to do it imprecisely. And so the choice that you face is that those companies which were investment grade, all of a sudden, because of the deteriorations in their incomes and their balance sheets, have become junk. And so all of them, a lot of, good quality at one level, considered good quality, becomes junk. And so do you say, oh, I'm not going to provide that money to those? It's just a choice. You have that choice. Okay. And you have to think about the consequences of the choice. So yes, it's correct that history has shown that central banks have bought stocks. Central banks have done anything. They will do practically anything and buy practically anything in order to save the system. So you ask what's systemically important, and they'll probably buy it. And therefore, you won't have a regular market. And then you, as an investor, get to make the choice of what do you own. You have that freedom. So, what do you own? What are you going to own? You have that freedom.
Ray, here's a question for you about the way you think about the company you founded, because it's a question that pretty much everybody who has any business anywhere in the world is thinking about. I want to know how you're wrestling with the debate over reopening the economy. How will you decide when employees come back to Bridgewater? And what impact is working from home having on uh, a culture like yours, right? A unique company culture, a culture of radical transparency. How are you wrestling with those questions, and how do you think it'll look in the months and even years ahead?
Well, we've been, I don't know, lucky or whatever it is. What we've done years and years ago was to assume that for one reason or another, it could be a hurricane knocks everything out, or it could be any reason, that we would have to be able to operate digitally and so on. And we've done that. We've operated this way, and made it in our normal practices to be able to operate this way. And so when there was the beginning of the virus, I mean, it pretty much, we knew what it would look like. We studied it in the past because it happening in China then also gave us a good sense, and we studied what it was like. And then so we quickly went operating in this way. And some differences in it, but the way we're operating is fine. It's good. And like human evolution, it's all a matter of knowing how to adapt. And there'll be new inventions, and humanity, it'll be, Zoom is very popular, and now online education will be very popular, and it'll prove, and I'm sure man will adapt. And so when we look about, let's say, the coming back, we're going to deal with the health case very seriously. There's a lot of silent transmission, and we're going to be very conservative in terms of how we're coming back, because this way of operating works fine. So we'll be conservative in when we're coming back. And we also believe that, studying pandemics, these come in waves. So, this is not like just one wave, like it's going to be gone. It'll be really more a question of human inventiveness in terms of coming up with testing processes. And, vaccines still look quite a way out there, but testing processes and various protocols and changes in protocols. And I'm sure that we'll find good ways of adapting to it, as the world will. And so we'll see, but we'll be conservative in coming back, and the way we're operating is, just fine.
Ray, with that, I want to thank you very much for joining us today. Ladies and gentlemen, Ray Dalio, and thank you to our audience for tuning in. This is the first in a series we call Invest Talks. Delighted to have Ray as our first guest. Folks, we'd also love to have your feedback about this event. An exit survey is going to appear on your screen shortly. You can also find a replay of this conversation with Ray Dalio by following the very same registration link you started with today. Stay tuned for more interviews in this Invest Talk series. You can follow us at Bloomberg Live on Twitter and LinkedIn for updates. Please also be sure to follow our ongoing financial and markets coverage on Twitter. At Business is Bloomberg's handle, and of course on Bloomberg.com. If you haven't already done so, please consider subscribing to Bloomberg at Bloomberg.com/subscriptions. I'm Eric Schatzker here in New York. I want to thank you all very much for joining us today. We'll see you at our next conversation here on Invest Talks.